Welcome to the Mortgage 101 podcast with Anthony and Manley.
Welcome back to the Mortgage 101 podcast with Anthony and Manley, the show that helps you cut through the noise, understand the process, move forward with confidence in any market. Let's get into it. Welcome back to the Mortgage 101 podcast. I'm Manley Haynes, joined by the ever-charming, always caffeinated Anthony.
What's up, buddy?
How we doing, buddy?
Man, we are in living color.
How about that? You're in frickin' Wisconsin, everybody. This is a big feat. I got Anthony to fly all the way from frickin' Kauai, 14-hour flight to Chicago, drive up in an Uber, sit here in the studio at Red Rooster Studios. What do you think?
Well, I know that you guys don't drive like we do on the island. I clocked my Uber driver going 122, and he was in the slow lane. I sent a text or an SOS to my twins and my wife, and she basically was like, "Should I call the police?" And I was like, "No, I'm in the slow lane. I'm like, we're good. We're good."
Oh my gosh, too much money. That is awesome. Well, I'm so glad you're here in Wisconsin. Like I said, we've been doing this. We've done 10 episodes already with you in Hawaii. Me here in Wisconsin, we've made all the technology work. It's been amazing. This is the first time you get to see the studio live and in person, which I'm super stoked for that. And I hope you enjoy it and all the hard work and effort that we're putting into this Mortgage 101 podcast. I'm hoping other people appreciate it, but let's get right back into the show. Sorry for taking us off track there. I had to do it.
It's good.
I'm so excited that Anthony's here sitting next to me live and in person.
Yeah, man.
Appreciate it, brother.
I appreciate you.
It's all right. Today is packed tighter than Anthony's espresso shots. Here's the lineup. MBS Market Watch. Why's the bond market swings have us feeling like mortgage surfers? Woo! And then the mortgage mindset. Are dropping rates a reality, or are they just markets teasing us again? Housing inventory crisis? If rates dip, will it rain on houses or hail headaches? Top buyer questions. The top 10 burning questions buyers are sliding into our DMs about. A snack. Let's buckle up and let's dive in. Here we go. Topic number 1, MBS Market Watch, surfs up, rates down. Anthony, the MBS market is swinging like my golf game, wildly unpredictable.
Well, I don't think comparing your golf game to the markets is good. I mean, at least the markets occasionally approve. Sorry, man. But
Ouch.
No.
But fair point. But seriously, folks, volatility is the spice of the mortgage life. It either gives you your budget wings, or clips them right off. Remember 2008?
Dude, it's like they're drama kings, man. The inflation right now in the market, it's a yo-yo effect. I mean, every day we wake up, we're seeing a different headline. We're seeing stuff, the rates are up, the rates are down. There's no more tariffs. There are tariffs. The administration using F-bombs. They're calling them daddy.
Wait a second. F-bombs at the friggin' White House, remember?
Yes.
Unbelievable.
Yeah, and then did you see the meme that he was making with they're calling him daddy?
Lord almighty. Unbelievable. Super awesome.
We actually saw the market change by that meme.
1,000%. It is super impactful, the stuff that this gentleman is saying right now, and good, bad, or indifferent. It's an actual anomaly that's never happened, and that's thankful or not thankful to the media and how it's all portrayed, and social media and how that's impacting people's thought process of what's going on.
Yeah, I mean, I think what we can see in this current market is exactly what you and I talk about, which is the market needs to know what runway it has. And if there's any volatility or uncertainty, what do?
They panic.
And they price defensively, right?
They have the fear factor come into play.
100%. I mean, my gut tells me that we have to prepare for everything and anything, because if we didn't do that, if we just looked at what's going on, our guts would say, dude, we are headed for greener pastures. And we are, I mean, don't get me wrong, we are headed for greener pastures. Yeah. High rates are behind us.
Yes.
Okay. We are not seeing high rates in our forecast. We are seeing nothing but lower rates. But the problem is,
time out. We could still see some spikes that are crazy. just from some of the commentary that's happened. And if we get, some bad PCE stuff we're going to get tomorrow morning, that could. So I'm just don't
That's
be
true.
bamboozled thinking that rates are going to continue to just dive slowly.
Yeah.
We're still going to have this up and down roller coaster.
But I think you can agree with me that the volatility, and I hate to say the word to our good friend Powell, is transitory.
It is,
because it wasn't.
It wasn't, but you are right.
And
but be prepared, because volatility still exists.
And here's the thing that I get. Okay, so you look on, your social media feeds, right? And what do you see? You see all of these armchair economists, and they are pissed off right now. They're like, what is Powell doing? And I kind of agree, but I kind of don't.
Yeah.
The reason why I say that is this: we made a mistake in the 80s. They laid off the gas too soon. And what happened? The rates went down. The inflation went down. They laid off the gas. And all of a sudden, we had a boomerang effect. And we had a stop-go market.
That's called whiplash.
That's stop-go. And so Powell is just trying not to repeat history.
Yep.
He's wanting to make sure that they want to see consistency. They don't want to see a one and done. They don't want to see, just quick and, hey, the rates are lower. They want to see consistency before they release the quantitative tightening, the QT. So
I've said this before, and I'm going to quote my best buddy Mel: hold, get your blue painted face on, folks. Powell's holding. He's saying that we're close, but just hold on tight. The big D man is pushing him hard.
No, he's pushing him, and he wants to, right? Because it's his
job.
It's his legacy.
He does. Yeah, but he's, 3 weeks ago we might not have been saying the same thing, but this is actually what should be happening right now. Hold. Let this get the smoother transition, the smoother landing to the runway that we can, as smooth as possible, so we don't have what I was telling you to stop and think. We still could have some spikes. So that's my 2 cents to it.
I agree. And, just remember the rate drop of 2020. It was like Black Friday sale in July. It was like, oh my God. And, we got comfortable with it. I mean, we were like, the rates are going to stay in the twos forever. And then we're like, I remember sometimes when I saw it creep up, it went as high as like a 3.2%.
And people freaked.
And they freaked out. And they were like, I'm waiting until it gets to the ones. And I'm like, I don't think you should do that.
There's a skeleton in the corner over there. It's probably over my dead body. But they got there.
Yeah, and
I locked some stuff in the one handles.
And if we can see anything, the silver lining is this: you have to not base your decisions off of fear and uncertainty. Yeah. You have to base it off of calculated understanding of where we were, where we are, and where we're going.
Education.
Facts.
And we're doing the best that we can do. We have a lot of information in front of us, a lot more than most. We have lots of stuff that we get to look at that gives us, where our thought process come from. Still, I don't have that magic Swami hat. Neither do you, or that crystal ball.
No,
I got that crazy 8 ball though.
Dude,
rates are lower, rates are higher.
But that's basically, it's par. I mean, it's hitting 3 for 3.
Yeah.
I mean,
we're better. We are better than a typical meteorologist or weatherman.
We're going to see later in this episode on the Rate Watch and Prediction Tracker on how, we should have trusted our guts and we should have not.
Hey, that's coming up.
Yeah.
All right.
I won't spoil it.
Okay. Spoiler alert. All right. Hey, we did get a little off topic there, but I think it was important. We're talking about, rates and all that and what's going to happen, but let's get into section 2, and talk about the mortgage mindset and, rates drops. And is it a dream or is it a reality check? Anthony, we've heard so many whispers about rates dropping. What's your gut telling you? We just talked about this quite a bit, but give me your prediction on what you think is going to happen here.
I mean, my gut's telling me prepare for everything, right? And anything. We can hope the rates are going to be lower, but we have to plan for stability.
Mm-hmm.
And I hate to say it, but I do think rates are going to be higher for longer. That doesn't mean they're going higher than where they're at. I'm saying that they're going to stay stable, and then we're going to see them slowly and strategically go down. We just keep your lender close, keep your documents closer, and keep your coffee closer.
Exactly.
Because it's going to be long. It's not going to be quick. This is not a sprint. This is a marathon.
Saratoga water, keep that close.
Dude, it's exquisite. It's effervescent.
I love it.
Saratoga.
Saratoga. All right. Well, let's get on to the ever famous rapid fire segment. And we have not our normal producer in, Kevin, who couldn't make it here tonight at the late hour. And we brought in a family member of mine who is thankful enough to be here and help us because we've been long-winded and working on our craft because Anthony's here for the first time. Bagner, thank you very much for being here. Say hi to the folks out there in the world.
Hey everyone, it's good to be here.
All right, so let's buckle up and get going. You're up, Bagner.
Awesome. Well, I'm going to shoot off some rapid fire buzzwords. Please keep it to one sentence only. So first one is pre-approval, your golden ticket into home buying paradise.
So is this me? I'm starting this.
I'm pointing you. I give you the red pen.
All right. So pre-approval. I mean, pre-approval is the start of the race, right? That's the entrance ticket into the arena. That's getting into Disneyland. That's in order to play, you have to prepare.
Yes.
And so a pre-approval is going to allow you to get an understanding of what your buying power is, what your payment's going to be, what your out-of-pocket cost is going to be. It's going to take out all of the question marks that you're going to have during the process. A lot of people think that you look at houses and then you get pre-approved. And that is not how to do it. You do not want to walk into a house and then think, can I afford it? You want to make sure that when you walk into a house, you know your payment, you know you're out of pocket, you know everything's been verified, been vetted out, been certified. So that way you have a blank check. And now we can not only shop, but we can shop with confidence. And we can show that seller, hey, we're not just pre-approved. We are fully approved. Everything's done. We've done our homework. We're not just looky-loos. We can sign a dotted line. And that is going to be needed, maybe not as much now because it is a buyer's market, but when it does turn, and it will, because history repeats itself, you're going to want to make sure that you have the strongest approval out there. Because if you're against people who've done their homework and you've only just have a piece of paper and you maybe gave it a couple of information, you haven't done like a power bid like Rate does, you haven't been fully vetted out and checked everything, you're not going in with the strongest, hand. You are going in with potentially losing out on the house of your dreams.
So to make that as strong as possible, and everything you're talking about is educating yourself and understanding what your payments can look like at various levels. And a good loan officer is going to help you understand, what you're qualified for, how high you can go, what each increment can go, so that, you're going to negotiate from your strongest point, and you're going to know exactly what that means when you put that bid in for $555 instead of $545. So you can strengthen your offer and walk away with a win, which is what you're trying to do. This sounds like a sports game, and actually it's a little bit like that. You're trying to put your best foot forward, educate yourself, be prepared to win.
That's a long one sentence answer.
Yeah, sorry. Maybe 3 or 4. Here we go again. That's your fault.
Next one, escrow, real estate Switzerland. That means neutral ground.
I don't know. Well, again, this is one of the funny ones because in Anthony's world, escrow means something different than it does over in my world. I'm talking about escrows of taxes and insurance and escrow holdbacks, which is the terminology that I'm used to.
Yeah.
Anthony calls the acceptance of a contract so that you're now under contract. He calls that in his world escrow because they're in an escrow state where they don't fund on the day that you close. They fund a few days after. And I don't know how many, 3 days?
So basically it's 2 days after funding, but you can't sign, you can't balance the docs the same day you sign, and you can't fund the docs the same day you sign. So you need 1 day for balancing, 1 day for signing, 1 day for funding, 2 days for recording. So you need a week.
Yeah, and then you actually get ownership of the house after it's recorded.
After the
That's
recordation.
when you get the keys.
That is correct.
That's when you get the keys. For my escrow, I'm talking about escrowing taxes and insurance, and that's a simple math problem that you take the overall annual payment of taxes and you divide it by 12, and you're going to make that contribution to your monthly payment so that those monies are available come the next time the actual property taxes are due. And and you do the same thing with homeowners insurance. So those are escrow holdbacks. So two different things, same world, same mortgage language, but they mean two different things depending on what we're talking about. There you go.
Good.
Next.
Underwriting, your loan's personal detective.
I mean, that's the big payday, right? You find the house, you compile all the documents, and then what happens? You send it to the judge. Just look at us like we're the attorney. The underwriter is the judge.
Yep.
They hand down the final sentencing. Is your loan approved or not approved? And so what you don't want is a lender that just throws it on the wall to see if it sticks. Okay.
Yep.
This is a relationship-based business. Okay. And especially if you are working with a retail or direct lender like us, and it's not a broker. I'm not saying bad to all brokers. You're good, but there's less control when you're brokers. There's relationships. We know our underwriters by first name. We know their families. We know their personal aspects. If they know,
ring them and say, hey,
yes.
Do you see this in the same light I see it?
Not only that, but it's kind of like ChatGPT. It learns and it knows the loan officers that throw it on the wall to see if it sticks. And it knows loan officers that take pride in their work and do their research and homework and make their jobs easier. We know the guidelines. This is not just we can't reinvent the wheel. So underwriting for us, and I know I know you're a stickler with this, but at least my team knows if we see more than 3 conditions come out, we have a better job to do.
Yeah.
We need to make sure that it's a clean approval.
My team and myself need to step up their game.
It's accountability. And the thing is this, we want the experience of the consumer, the client, to be a good one. What you don't want, and you hear these horror stories of these nickel and dimes piecemealing to where every day I need this, I need this, I need this, I need this. That is a very reactive origination. You want to be a proactive origination. You want to answer the questions before they're asked of the underwriter.
Yep. The one thing that I will say is sometimes documentation creates more questions. And so that's why we like to view our documents before we present them back. So it's how we're painting the picture to our underwriter, because not that we're trying to be deceitful or withhold anything, but they don't always have to see everything necessarily in the same light. We want to put it in the perfect light, so they do it. Our world relies on third-party verification of almost all documentation.
Yeah.
Not just my eyes coming from the borrower. It's coming from some third-party entity that isn't involved in this transaction. And that's what we provide to the underwriter. And that's where we got to just make sure, are we giving the correct information and are we giving exactly what's needed? So I'm just not saying that I'm not trying to say that nickel and diming isn't part of it. It's not. Sometimes something comes to light after a question is asked, and we got some large deposits we have to worry about.
Or they can't unsee it. Once they see it, they can't unsee it.
Correct.
For instance, hey, if you're not following the guidelines, us, and we're not reading DU or LP or AUS, which is basically the bank is, there's thousands of people getting loans a day. If it was manual, you couldn't get anything done. So what we do is we run it through the system, and the system, the central bank, kicks out a little report, and it tells the underwriter to follow it to script. Do not ask for anything. If they do, that is overlays. Yeah. And at least we can talk. We have no overlays.
We can have no overlays.
Yeah, we go straight. Whatever the central bank says, that's what we go off of. And so you can kill a deal, for instance, if you put in 2 years worth of tax returns. They have a year that was a killer year, but the previous year was not.
Yep.
But we have to average it. But then AUS says, well, they've been in business for 5 years.
We only need one. Yeah.
And
so be careful.
Yeah. And so
a seasoned loan officer will make sure that he understands what gets into the file and in front of the underwriter prior to that happening. So we're painting the picture. We're not trying to be deceitful. We're trying to make sure we paint the proper picture. Anyway, that's right. We got really deep on that, but
we're
that's
so
good.
bad.
We're so bad. It's bad. All right, Bagger, you're next.
All right, guys. Well, we've talked a little bit about interest rates and how they can fluctuate. So let's talk a little bit more about your mortgage's best friend, the rate lock.
Is this me?
Well, I'll take this because I got an interesting one going on myself right now. But
you do.
I have a lock 'em if you got 'em mentality. And there's this old saying that
wait, you don't gamble with your clients?
I try not to.
Like a slot machine?
The only time I do that is when they demand it. And sometimes I question them, just like I'm questioning people right now. Like, pigs get slaughtered. Like sometimes if you're trying to find that bottom number, that's when we get these little spikes. I already talked about it a little previously. We still have volatility. If something happens, especially tomorrow morning with PCE coming out, if it goes the wrong way, we're going to see a spike in interest rates. Interest rates jump up and they grind down. So we could lose all the traction we've made in the last week very quickly. And that's what scares me. So lock them if you got them, if you're comfortable with it. Right now, we've seen the best rates we've seen in some time in the last couple of days. So, but the rate lock is the rate lock of the time and date. And you need to know, am I doing a 30-day lock? Am I doing a 45-day lock? And that's all relative to your closing date. The longer the lock time frame, the higher the interest rate. The shorter the time frame of the lock, the lower the interest rate. So also one other thing to mention with a rate lock is we've locked it on purpose, that we've committed to delivering this product with this loan for the specific loan amount that we locked it at. If something changes in the market drastically, we've talked about this before, if the market moves at 0.3% or more, we can do a one-time float down and bring a customer down to the new rate if it moves at 0.3%. Anything below that, we don't do that because we are hedging our position and it costs us money. And so we have to have a policy that says 0.3% or better before we make that one-time move.
Yeah, and one thing to note too is the Fed rate is not the mortgage rate. So many times, like I will just get bombarded by calls when we see some movement with the Feds and they'll go, are the rates back down to the 3s yet? And I'm like, bro, like
what planet are you on?
Yeah. And well, what I do is in my head, I say, bro, but I know that they're not the mortgage professional. So I go and I have to educate them and go, you're going to have to see 3 or 4 moves on the Feds to be able to see a substantial move on the rate market.
Half a percent or something.
Yeah. But the rate lock, you said it best. You don't want to bring the pigs to slaughter. You want to make sure that you put your client in the best position possible, which is plan for the worst, hope for the best. And how do you do that? You lock them when you got them, unless there's some massive news that has a high likelihood to move it. Don't gamble.
And if you're willing to gamble, that's on you.
Yeah.
You are not going to find bottom until it's come and gone.
Yeah. Do not chase the rate.
We can't chase that rate. So
Yeah.
that's what I'll say.
Yeah.
Sorry. Long-winded again. We're going to be here for 10 hours.
Yeah. Welcome to the 7-hour podcast.
This next one is sneaky but essential, kind of like that extra guac, talking about closing costs.
What's in the guac, actually?
Do you like onions when you're
I
guacamole?
like a little onion in my
Do you
guac.
like yellow or red? Or is it red?
I like red onions.
I like red too. My wife hates onions in the guac.
You know what my wife hates?
What?
Cilantro.
Oh.
She's one of those cilantro haters
Dude,
where it tastes funky in her mouth.
That's like
It's a staple.
that's disturbing.
I find it very disturbing, and we fight all the time over the fact that
Cilantro.
I know Bagner's a cilantro fan, and we've made some cilantro items back at the home, and Mama has a fit. Mama has a fit.
Yeah, that's crazy. I don't know how we got on that.
All right, so here we go. Guacamole, we're out. Closing costs, you're up.
Closing costs. 3 buckets. You have your third-party closing costs. You got your prorations, and you got your points. Okay, there's a big misconception in there. Points. That goes in your pocket, right?
Yeah, my pockets are full too, by the way.
That's right. Yeah.
No,
We charge points on the front end, on the back end, on the side end, on every end, right?
Exactly.
Yeah. This is 2007, and we work for Enron, and we are now incarcerated. So, sorry.
Oh boy.
Flashback
There we
of
go.
the people in this market.
He's the one with the tattoos, not me, by the way.
20 years ago. No, basically, there was an overhaul with all the bad actors in our industry eons ago when there was no regulation and there was no red tape. I'm not a big proponent of oversight, but I am a big proponent on oversight when it comes to markets, manipulation, and the consumer.
Yeah.
So I think it's good because we now have protections in place to make sure that bad guys have to be licensed and bad guys don't get licensed. Bad guys have to have continuing education and bad guys don't have continuing education. And bad guys have scrutiny and bad guys don't get scrutiny. That's what we live in this world. We have a microscope on us. We get audited, and we have to make sure that our fiduciary obligation is to the consumer. And here's the biggest aspect. With the closing costs, we do not get paid by your rate. We do not get paid by your program. We get paid by the volume that we close in. So
Meaning the loan amount.
yeah. So if we got a $1 million loan and they put $800,000 down, we're making money off of a $200,000 loan amount, and it's from the bank. It's not from the consumer. So your closing costs, what you want to look out for is for sneaky fees, origination, broker fees, junk fees. You want to make sure that you're not getting inebriated with all these fees that are unnecessary. Now, you're going to have third-party fees like title, escrow, taxes, insurance, prorations, appraisal, county fees. These are all standard, but make sure when you do get your closing costs or your closing disclosure or loan estimate, you're looking at how much is this lender charging me? You're going to see anywhere between $1,000 to $1,500. That's the going rate. If you're trying to save $100, time is money. And if you go to a credit union to save $100, you're going to have a 70-day close. You're going to talk to someone who's not licensed, who's got to talk to another person who is licensed, who will get back to you within 5 days and gives you banana generic, answers. Whereas when they work with us, we're the source. They're coming to us. We're not sending them to someone else. So I would definitely, you get what you pay for. Time is money. And if you're looking to save $100 on a $500,000 house, that's
on you, but that's
on you. Exactly.
Yeah. There's always a cheaper cheeseburger. How they taste is a whole nother word. And are they actually beef?
Facts.
There you go. Next, please, Mr. Bagner.
Appraisals, the unbiased matchmaker of price.
Interesting. Unbiased matchmaker. I like that.
That's nice.
Interesting.
That's a good ring.
Good ring. Everybody kind of comments and says it's really odd. Had this today again. Really odd that the appraisal in his reaction was even funnier. That the appraisal comes in exactly at the amount of the offer amount.
Yeah,
and I'm always like, well, that's kind of how it goes. And
why is that? Why is that, Manley?
Because that appraiser just read the offer and said, that's what I'm going to give it the value for.
But doesn't he want to manipulate the market based off of his opinion?
He does. He just puts his own opinion in there. It doesn't matter what actually it's worth. He just writes down like, oh, this is easy. I'm going to get my fee for just writing down and match the accepted offer.
So the appraiser's not licensed and he doesn't have 40 or 50 different subsets that have exact specific specifications and calculations?
I hope you hear the sarcasm that's going on here right now, folks. He has some very specific guidelines and rules that he has to follow that are very particular, and it can be a little damning at times because he has to use comparables that are sold homes as a similar square footage, size, square footage, within a small radius, within a 6-month time frame, so that they're all like in kind properties, and that's what he uses to bracket it and do his calculation to come up with a valuation.
Is it safe to say that the valuation is based off of science and not interpretation?
It is 1,000% science, and there's very little interpretation, and that's why they typically come in very close to the offer amount, unless they're somebody really overbid or the thing was completely undervalued. And then that's when we start seeing some deviation. This particular client of mine today was hopeful that his appraisal was going to come in extremely lower than it did. Took me back. He was hoping to save money to come back and renegotiate with his seller. And I'm like, oh my Lord, this came in exactly at your purchase price, which should tell you that you're spot on.
That's a good thing.
That's a good thing. And, for about 10 seconds, he was crying that he wanted it at the lower rate or at the lower amount, but then understood.
Did you tell him to read the 45 pages?
Yeah, exactly.
Yeah.
So there's so much that goes into it. And unfortunately, our favorite realtor partners typically aren't fans of appraisers because it does cause some turmoil.
Yeah.
But here we go. So moving on.
What do we got?
All right, guys, I think we might have failed a little bit on the one sentence only part of this. So I'm going to try this next one in 3 letters.
Kevin would be proud.
Kevin would be proud.
PMI.
That's you, bro.
PMI?
Yeah.
Private mortgage insurance.
There you go.
There you go.
There you go.
I
knew where you were headed.
That is when you're putting less than 20% down, and we need to have that great private mortgage insurance so that the investor can mitigate his risk and make sure that he's covered in whole when there's a default situation. So it's specifically to protect the lender so that they are more apt to give you money beyond an 80% loan to value. The PMI itself is driven by debt to income ratios and credit score and loan to value. So those are the 3 factors that move the PMI cost for you. And PMI today is fairly inexpensive for the most part. It lot of people back in the day were using home equity lines of credit in place of PMI, but the math doesn't seem to hold water today. The monthly payment for PMI is typically lower than getting a home equity line of credit for that 10 or 15% that you're looking for above and beyond your original first mortgage of 80%.
Yeah, and here's two things. I'm going to infiltrate your.
Okay,
I'm going to take the stage
take it.
on this 1 sentence
Take it.
/ 20 sentence. PMI is a good thing. PMI is your friend. PMI is not your enemy. You hear me? And why is that? Because our parents' had to put 20, 30, 40% down. They didn't have private mortgage insurance. Whereas now, y'all can put 3% down. And when you look at it, would you rather save 20, 30, 40,000 for $100 payment or $1,200 for the year? You can make a lot more money with that money somewhere else. So it's a good thing. It's not a bad thing. And the other thing too, here's some bonus information for y'all. Do you think that rates are better with mortgage insurance or without? I'm putting 20% down, so of course my rates are going to be better, right, Manley?
Wrong.
Well, why?
Well, I already explained to you why. The end investor has his risk mitigated because he gets more money in the default situation because he gets that gap between the 80 and 100% coverage
Insurance policy.
from the insurance policy. And so it's in his best interest from a business perspective to have a loan with mortgage insurance between 24% and, 95% or 24% equity or 5% equity.
So you're saying that if I put 15% down, I'll have a better rate than 20% down.
Yes.
But then what if I put 25% down?
You'll have an equal rate. If you put 30% down, it'll be better.
Because it's farther away from that gray area. That makes sense.
Statistics bump into that play, and they have all these statistical charts that say the
I'm all about statistics.
statistics. Are they going to default or are they not going to default?
If your lender does not follow statistics, then you need to get a different lender.
Or strategery.
We are lenders that follow strategery and statistics. That's facts.
Moving on.
Let's hit refresh here.
By the way, we lost camera too.
Yes. Our last buzzword here is going to be refinance.
That am I taking it? I'm taking it.
You can take it. You can jump right in, and I'm going to squash it. Okay.
I mean, I'm having to spend a lot of time creating personal videos for my hundreds and thousands of clients because it is going to be a stampede of bottom feeder lenders who have no business talking to people they have no relationship or they look after. They are looking for a transaction. They're not looking after that person. What do I mean by that? Are they going to do the math and look at your break even? When you do a refinance, you're trying to save money. But more importantly, you want to save money that makes economical sense. What I mean by that is if you're going to refinance, what is your break even? Meaning, how much is it costing me to refinance? And how long will it take of me saving that amount per month to break even? And if it's taken 5 or 6 years, you're going to be really mad in 2 years when you can organically get that rate without that extra cost. And now you just lost all that money.
Do you have like a rule of thumb that you like to sort of like throw out there and say, if my break-even point in months, terms of months, that this makes economical sense to do this, or because that's how I operate. I kind of have this range.
If I worked for Davy Crockett Mortgage, then I would be like, you need a 45-year break even. As long as you make up the cost in 45 years, let's get it done.
We be living on possum stew for a while too.
But luckily, you and I don't work for Davy Crockett Mortgage.
Nope.
And we work for Rate, who looks after the client with math. And we're going to look at it and say, what is it costing us? And the break-even rule for me is anywhere between 18 to 36 months.
Okay.
For me, 18 to 36 months is going to make sense because I want to make sure I'm setting up the client for an opportunity to do another refinance without leaving money on the table, because what's going to happen over the next 3 to 5 years? Rates going down.
12 to 18 is what's happened with you. Why haven't you done this already? 18 to 24 is, let's get on it. We're in a hurry. 18 to 36, when you're getting to from 24 to 36, then we're saying, okay, how long are you planning on living in this house? We're asking some deeper questions. Are you going to be here for the next 3 years? Because if you're not, then what are we doing? And so we're in that gray area, getting to that after 36 months, hold on to your short.
But do you see what you're doing? You're doing some hard thinking right now. You're not thinking about, I just want to get this transaction done.
No.
I just need to get some Chipotle in my life and I need some paychecks. You're looking at the math. And you only get that when you have a relationship with your lender. If it's just some dude who called you up, a bottom feeder, who's just trying to give you some smoke, and you're just like, it.
And drop $8,000 in origination fees and your closing costs that you didn't see.
Here's a great way for all you clients out there who are looking to refinance in the next 36 months. If they try to lead you with a rate, they are trying to hide stuff from you.
Yeah.
You need to make sure you look at the math. How much is it costing me? How much am I saving?
Yeah.
What is my break even? End of story.
You got to do 2 or 3 options, see the break-even points, what makes sense, what doesn't make sense. The math will tell you what to do. And
Math doesn't lie.
And why I go through that little process that we just talked about is because I really, truly want to treat people like I would treat my mother. God bless her soul, she's not with us. But, I want to treat her. And does this make financial sense for you? And we keep saying that, like, does it make financial sense? The math will tell you.
We work in a relationship based. We are relationship builders that happen to be in the business of mortgage lending. And how can I sit on the side of a table across from someone and tell them something that doesn't make economic sense? They're not going to trust me for their next loan, for their kids' loan, for their grandparents' loan. And that's what we want. We want relationships that are generational. And the only way that do that is to follow math. And so I just implore anyone watching this, if you do have that trusted mortgage professional, you always trust, but you always verify. How do you verify? Through math.
Yep. The math will set you free.
That's it.
Housing inventory crisis. Deja vu, anyone?
Are we really heading back into an inventory crunch, Manley?
Feels like history repeating itself, Anthony. Remember when finding a home was like winning the lottery? We are inching towards those days again.
I mean, listen, they got to be prepared, dude. They got to be prepared. They were caught off guard when the rates went from the 2s to the 9s. And they did. It's hard to say that, but we were locking in the 9s at one point, and it was just, we were scratching our head going like, all right, I locked you at 9.6. Your mortgage is $19,000 a month. Have a nice day. But I will say that prices went up. And when you look at the difference between, and obviously they don't have a $19,000 mortgage, but when you look at the difference between waiting for that perfect time and when you look at trying to time the market, you're never going to time it. It's like a teeter-totter. You pay Peter to rob Paul. You're never going to time it. What you can time is, do you want to keep paying a landlord? Do you want to not pay down the principal? Do you not want to have earned equity? Do you not want to have tax incentives? Do you not want to have a nest egg and generational wealth? Keep renting.
Hindsight is 2020. You're never going to see it till it's way past. And until you get off that fence and stop worrying about that, that's where we're going to be.
Do you remember when trying to find a home was like winning a lotto?
That was there.
Dude, there was like 20 offers on one house. And I remember getting like, give me your highest and best. You're paying for all of the seller's closing costs. We're not paying for a warranty. And we're taking the windows, like stupid stuff like that.
I remember seeing 4 realtors with video cameras. They didn't even have a customer with them. They're walking around showing them a house through a video camera phone. And that's how they bought the house. And they were putting in crazy offers like you just said, highest and best, no nothing.
My favorite was, there's 2 of them. There was one in California where, and this is real, you could put in the contract that you want the airspace above the property. And they put that in there. Just like I had one during COVID. They wanted mineral rights. The sellers were selling the property, but in the event they hit oil, the previous owners got those rights.
Lord almighty.
And you know what? They were doing them because there was 20 people wanting them. And I guarantee you one of them were like, this ain't Yellowstone. I don't need the oil.
Forget it.
Correct.
Forget it. Holy moly. I think we're going to talk about a rate watch and prediction tracker now.
Yes. The rate watch and prediction tracker, which we talked about earlier.
We've talked a little bit about this earlier. It's something that we've been working on, and I sort of slowed your roll for a second because it's something that you and I have been talking about, and we've gone back and forth. We kind of panicked, didn't we? 3 weeks ago, we kind of panicked.
We second guessed ourselves.
We did.
Because let's face it, the past couple months has been volatile, right? It's been untrackable. It's been the 8 ball, right? It's just like 1 week it's tariffs, next week it's war, next week it's rates, next week it's
tariffs.
It's a tweet. Or do we call it tweet still? I don't know.
Like that. Yeah, I think it's still tweets.
Yeah.
I think he's still tweeting.
But I would say that we when we first started this rate track prediction, our goal is to see what, to really kind of grade ourselves on how we're seeing,
Where are we doing?
how we see the market tracking and how we see that, what are we predicting, right?
I mean, over and under in Vegas, like there is an over and under out there for us right now. And I think right now everybody's saying the over, but I think we're going to go back to the under. And
I would say if I can turn back time, then I would stick with our original.
That's a great song.
Turn Back Time?
Yeah.
Who sings it? Oh, there's a big age gap here.
You don't know who sings the Turn Back
We
Time?
can turn back time. I don't know. Is that Michael Jackson?
No.
Is it Aretha Franklin?
No, it's not.
Tina Turner?
No, it's not.
Turn Back Time. Lady Gaga?
No, not even close. You don't know who it is? I'm going to keep you going here for a little bit.
Chris Stapleton? I mean, I'm in Wisconsin, so y'all cowboys.
She's a little older now. She's tall and beautiful, dark hair. She did a couple movies.
That really narrows it down.
She did the pizza movie in, where was that pizza movie?
Turn Back Time. Madonna? Who is it?
Come on.
I don't know. Dolly Parton?
No, it's not. And actually, I'm drawing a blank on her name too. That's why I'm just dragging you on. It's the Moonstruck.
Cher?
Cher. Turn back. Yeah, Cher.
Hey, Cher.
I was losing her name. I could see her.
Moonstruck.
Moonstruck. Yeah.
Cella Luna.
Yeah, Cella Luna.
Ah.
And who was our other guy that was in there?
No, yeah, you got me. I know Cher though.
Okay.
You
All
know,
right, we'll move on.
Push your sings like this. I don't know, but
Yeah.
anyways,
We went down a path again.
yeah.
Sorry.
What we were talking about is if we were to look back at what we initially stated,
Yep.
looking at we saw that basically our forecast was between 5.8 and 6.5 initially. That's what we said.
Yep.
And then we changed it to actually our original forecast was 6.1.
5. Yeah.
So, and then we changed it, I believe, to 6.8
Yep.
because we were like headed into dark days.
Yeah. Yeah. A lot of tariff stuff, a lot of unknown, all this this stuff with Powell. And we were kind of against him at that time too, a little bit. Like
We were?
like, move the rates. What are you doing?
Yeah, we wanted to slap
You're
him
an
around.
athlete. What are you doing?
Yeah, we're like, what are you doing? Like
And
you're
that was the Bronco
lethargic.
chase.
We did the Bronco, right? We did
did
the
the
Bronco
Bronco
chase.
chase.
But here's the thing, though. We're not talking like 6 months ago. We're talking like weeks. That's how fast.
Yeah, 4 weeks. Oh,
Yeah. That's how fast this market is changing volatility wise.
Volatility is crazy.
I'm good with our original forecast of 6.1.
I think we're gonna get that. We had Bill on a couple weeks ago, and Bill was saying that he
was
was more like a 5 handle,
He's
5.875, 5.75.
he was bullish. He said in the fives, and you and I were like, and we just came off of that like
okay.
we were like,
Yeah.
oh, okay. But he came with facts.
He did.
He was coming with facts, and I was like,
We got to get Bill back on.
we do. We need.
He was really, hey, we are telling our opinions. He's got a little higher level of
Well,
understanding.
he's a master at taking complicated things and bringing it out to 5-year-olds.
Yeah.
So it's
We got to break out our box of crayons.
yes, I agree. So yeah, so 6.1, I'm sticking to it.
Sounds good.
Yep.
I'm with you, buddy.
Cool.
I'm with you. All right. Well, let's final thoughts. And I'm just going to go through here and talk a little bit about our final thoughts. We talked about it a lot. Be ready for this volatility because it's still going to continue. We talked about pigs getting slaughtered. Lock them if you got them. Don't think you're going to find rock bottom on your own. You're going to find out where it was way after it hit, and it's gone the other way and boomeranged on you, whacked you in the back of the head, like the whip when you don't know how to actually do the whip. You got to act on your opportunities quickly. Stay informed. Educate.
Yeah, I mean, be ready. Okay. Do not be reactive, be proactive. Get pre-approved. If you're looking to purchase within the next 5 years, there should be no reason why you can't talk to a mortgage professional right now. At least understand the terrain, understand best, worst, and middle outcome. Get your documents ready, keep your lender close, but more importantly, keep your expectations flexible. Okay. Don't plan for the best and hope for the best. Plan for the worst, hope for the best. You won't lose any sleep. You can save your gambling for Vegas, and don't save it for your financial future.
Well said. Thank you, folks, for listening and watching. And I hope you smash that like button. Hope you subscribe, follow us for more mortgage insights here on the Mortgage 101 podcast with Anthony and Manley. We really appreciate your viewership, your listenership, all that great stuff. Looking forward to seeing you again on our next episode. Anthony, I got to say, huge shout out for making it all the way over here. Your arms got to be sore from all that flapping you did to fly over here. So appreciate that.
Yeah, 14-hour flight. That's always fun. But yeah, no, it's great. I'm glad that I'm in Red Rooster Studios. This is absolutely amazing what you did. So I'm super grateful that even though we're on both sides of the hemisphere, we bring our minds together. And hey, DM us your questions. We love to hear from you. So we get really good questions. And so you our viewers, you guys are the heartbeat out there of which we abide by. So DM us your questions and we will feature your questions on the next podcast.
Yeah. Thank you very much. Thank you, Bagner, for being here and being our stand-in for Kevin. Kevin, we miss you. And again, appreciate everybody watching. Love you all. If this episode helped you feel more confident about your home buying journey, do us a favor. Share it with a friend, subscribe, leave a review, and if you've got a question or topic you want us to cover, hit us up with a DM or a comment. Thanks for listening to the Mortgage 101 podcast. We'll see you next time.